The Monetary Authority of Singapore has tightened guidelines on all property loans granted by financial institutions. The central bank says the move will strengthen credit underwriting practices among banks and encourage financial prudence among borrowers. The new rules, which will kick in tomorrow, are also meant to ensure that monthly loan repayments by property buyers do not exceed 60% of their income. Wong Siu Ying tells us more.
Well, the analysts I spoke to say technically this is not a cooling measure, but more of an extension of what the government has been doing to make sure buyers do not overstretch themselves. Now, the MAS says it will introduce a total debt servicing ratio framework for all property loans, and it basically requires banks to take into account all the outstanding debt obligations of the borrower when they are processing loan applications. These obligations are wide-ranging, including home loan, study loan, car, financing and even credit card debt. Now, the banks will also have to discount at least 30% of the borrower's variable income and rental income. MAS says it is implementing this framework because it has found that banks here do not have a standardized method to calculate debt servicing ratio. Now, in addition, the MAS will also refine rules related to the application of the existing loan-to-value limits on housing loans. Now, for example, in the case where two individuals are buying a property, the banks will be using the income-weighted average age of the two borrowers to determine the loan tenure. This means joint borrowers will not be able to tap financing based on the age of the younger buyer, which could make a difference in terms of the loan tenure and how much cash down payment they have to pay for the property. Now, as a result of these measures, some analysts say demand could slow as buyers work out their finances and banks crunch a lot more information. But the overall impact on the property market is likely to be marginal.